The world's most powerful nation had a promise that every American dollar could be exchanged for real gold. For decades, that promise held together the global economy. Then, one summer weekend in 1971, foreign governments began demanding their gold back. Behind closed doors at Camp David, President Richard Nixon and his closest advisors faced an impossible choice: keep the promise and risk emptying America's gold reserves, or break a commitment the United States had made to the world since the end of World War II. On August 15, 1971, Nixon stepped in front of a television camera and made an announcement that changed money forever. Most Americans barely noticed, yet every dollar in your wallet, every mortgage, every stock market rally, and every financial crisis since traces back to that single day. This is the story of the day America almost went broke. When World War II ended in 1945, much of Europe and Asia lay in ruins. Factories had been destroyed, economies were shattered, and many nations faced the enormous task of rebuilding from the ground up. The United States emerged in a very different position. Its industries were booming, its infrastructure remained intact, and perhaps most importantly, it held nearly two-thirds of the world's official gold reserves. In 1944, even before the war was over, representatives from 44 Allied nations gathered in Bretton Woods, New Hampshire, to design a new international financial system. Their goal was simple: prevent another global economic collapse like the Great Depression. The agreement they reached made the US dollar the foundation of world trade. Every major currency would be tied to the dollar, while the dollar itself could be exchanged for gold at a fixed rate of $35 per ounce. To the world, the dollar became more than paper. It became a promise backed by America's vast gold reserves. As long as that promise held, nations trusted the system. Trade flourished, economies recovered, and for more than 2 decades, the financial world rested on a foundation that seemed almost unbreakable. Few imagined that beneath its polished surface, tiny cracks had already begun to spread. By the 1960s, the system that had helped rebuild the world was beginning to strain under its own success. As global trade expanded, countries needed more US dollars to buy goods, settle international accounts, and build their own financial reserves. America gladly supplied them, but there was a growing problem. Every new dollar circulating overseas represented another promise that it could be exchanged for gold. At the same time, Washington's spending surged. The Vietnam War demanded billions of dollars each year, while President Lyndon B. Johnson's Great Society programs dramatically increased domestic spending on education, healthcare, and poverty relief. Rather than raising taxes enough to cover both priorities, the government relied heavily on borrowing and expanding the money supply. Inflation slowly crept upward, and foreign governments began asking an uncomfortable question: was the United States printing more dollars than it could actually redeem with the gold locked away in Fort Knox? On paper, America still promised $35 would buy 1 ounce of gold. In reality, the number of dollars in circulation was growing much faster than the nation's gold reserves. Confidence, the invisible currency holding the entire system together, was beginning to erode. One determined leader was about to test whether America's promise was still worth believing. That leader was French President Charles de Gaulle, and he believed the international monetary system gave the United States an unfair advantage. As long as the dollar served as the world's reserve currency, America could finance wars, import goods, and spend beyond its means simply by creating more dollars. Other nations had to earn wealth. The United States could print the currency everyone else depended on. De Gaulle publicly challenged the arrangement, arguing that true money should be backed by something tangible, not promises. Then, France did something that sent shockwaves through Washington. Instead of holding its growing pile of US dollars, the French government began exchanging them for physical gold, exactly as the Bretton Woods Agreement allowed. Other nations watched closely. If France could trade paper for bullion, why couldn't they? One by one, central banks started converting dollars into gold as well. America's gold reserves began shrinking at an alarming pace. Tons of gold quietly left U.S. vaults, while billions of dollars remained in foreign hands. each one carrying the same claim on a reserve that was becoming dangerously thin. The question was no longer whether the system was under pressure. It was whether the United States could keep its promise if everyone demanded their gold at once. By the summer of 1971, the pressure had become impossible to ignore. America's gold reserves had fallen dramatically from their post-war peak, while tens of billions of US dollars circulated overseas. If foreign governments continued redeeming dollars for gold, the Treasury risked watching its reserves disappear. President Richard Nixon knew the crisis could not be solved with speeches or small policy changes. On August 13th, he quietly left Washington for Camp David, Maryland, gathering a small circle of trusted advisors for a secret weekend of meetings. Among them were Treasury Secretary John Connally, Federal Reserve Chairman Arthur Burns, and a rising Treasury official named Paul Volcker. Behind closed doors, they debated choices that all carried enormous risks. Raise interest rates and slow the economy, devalue the dollar, impose trade restrictions, or take the unthinkable step of ending America's promise to exchange dollars for gold. Every option threatened jobs, financial markets, or America's credibility abroad. Hour after hour, maps, charts, and economic forecasts covered the tables as the group searched for a way out. By the end of the weekend, Nixon had reached a decision that would rewrite the rules of the global economy, and almost no one outside that room had any idea it was coming. On the evening of August 15, 1971, Americans tuned in expecting another presidential address. Instead, Richard Nixon delivered one of the most consequential economic announcements in history. Speaking calmly from the White House, he declared that the United States would temporarily suspend the ability of foreign governments to exchange US dollars for gold. He insisted the move would protect the dollar from international money speculators and preserve America's economic strength. Alongside that decision, Nixon announced a 90-day freeze on wages and prices to slow inflation, plus a 10% surcharge on imported goods to pressure trading partners into new negotiations. The public largely applauded. Many saw a president taking decisive action against rising prices, but economists and foreign leaders immediately understood the deeper meaning. The temporary suspension effectively ended the Bretton Woods system that had governed global finance for more than 25 years. The dollar was no longer backed by gold. For the first time in generations, the world's reserve currency rested almost entirely on confidence in the United States itself. Money had changed forever, and there was no going back. The effects of Nixon's announcement rippled across the globe almost immediately. Without gold anchoring the dollar, the Bretton Woods system quickly unraveled. Over the next 2 years, most major currencies stopped maintaining fixed exchange rates and began floating against one another, their values determined by global markets instead of a set price. Governments and investors entered unfamiliar territory, where confidence, interest rates, and economic policy could move currencies overnight. At home, the United States gained far greater flexibility to manage its economy, but that freedom came with new risks. Inflation accelerated throughout the 1970s, fueled by expanding money supplies, and later intensified by the oil crises of 1973 and 1979. Prices climbed, savings lost purchasing power, and interest rates eventually reached levels few Americans had ever imagined. Yet despite predictions that the dollar would lose its place in the world, it remained the dominant global currency. Nations continued holding dollars, businesses continued trading in dollars, and confidence shifted from America's gold reserves to the strength of its economy. The financial world had entered a new era, one built not on precious metal, but on trust. More than 50 years later, the consequences of that August weekend still shape everyday life. Every paycheck deposited, every home mortgage approved, every stock purchased, and every dollar spent exists within the financial system created in 1971. Today's money has value not because it can be exchanged for gold, but because people trust the institutions that issue it and believe others will accept it tomorrow. That trust has allowed economies to grow, but it has also made debates over inflation, government debt, and central bank policies more important than ever. Supporters argue that leaving the gold standard gave governments the flexibility to respond to recessions and financial crises. Critics believe it opened the door to excessive borrowing, larger national debts, and a dollar that steadily loses purchasing power over time. The debate continues with every economic downturn, every rise in inflation, and every new digital currency promising an alternative. Yet regardless of where that argument leads, one fact remains unchanged. In August 1971, a single presidential decision transformed money itself, quietly reshaping the global economy in ways that continue to influence every American today.